What is up, everybody? Today's video is going to be about how to sell a put option. What is a put option, you may ask? A put option is a contract that another person buys from you or that you sell to sell an underlying stock. And so today's video is about how to sell a put option, which is inversely correlated with buying a put option. So let's elaborate further on SPY. Make sure to go to trade options. And then, just for reference, the longer you go out on the date, the more premium you're likely to get. So let's just do August 10th. Make sure to hit the sell option. And then make sure to switch it to put. And then, so there's different ways you can do this. You can go above the strike price or below the strike price. Today's video will do below the strike price. But, for example, if you chose above the strike price, you would basically just have to hope that the stock goes above where the strike price is. If you are not wanting to basically immediately have to buy 100 shares. Yeah. So let's just say you're wanting the stock to be cheaper, because usually when you sell a put option, you're wanting to buy shares cheaper for than what they are, or at least get a premium for it. So basically, I mean, there's several different strategies to do this with, but like if you're fine with buying the stock at the current price right now, you could honestly just put a put option and save yourself some money. After it expires is when you have to buy it. So there is some of that time decay difference if you're patient with it. But most people, when they sell a put option, they want it to decrease a little bit. Hopefully, if it's like the price is higher than like at a 52-week high or whatever, they're expecting for it to have a correction, so they will sell a put option for like say 390, even though that's not that much lower. But we'll just use it as an example. They'll sell it for 390. 395 to 390. That's a $500 differential times 100 shares, because options are always in 100 shares mathematically. So that's what you'd be opting to buy. So basically, what would happen is you're hoping that it doesn't go down past this point, the strike price that you set, or stays there. Like, so it can go down as far as here, but then you'd be obligated to buy anything under 390. So to make a profit. Otherwise, if it just tanks to 380 per se, you would still be obligated to buy it at 390. So that's not the best alternative, especially since on the inverse side, if you wanted to do the wheel strategy, which is I'm a big proponent of, you'd have to make a profit, unless the premium is good enough to warrant it, have to sell it back above 390. But by the time it's 380, selling a call to 390 or 391 to break even, which it wouldn't really be breaking even. You'd have some premium left over that would mitigate some of your risk, which is why this is such a great option strategy. A lot of the big dogs use it when they trade options. They usually are option sellers rather than options buyers. And if you have some money, I would definitely recommend it. But I'd only recommend it on stocks that are semi volatile, but mainly ones that you were already interested in buying and holding long term. So mainly do it on ETFs. Maybe if you're feeling a bit more pushy, some things like TNA, that's a 3x leverage bull option that follows the S&P. Do it on stocks like Apple or Microsoft. Any of those are great safe bets where you can get some decent premium. SPY is a great one to do it on, because you could theoretically, their options expire every 2 days. So you could just get $100 every couple of days or something if you have the capital to be able to even purchase 100 shares, which is what some of the big dogs do. But yeah, so like the loss would be, it says infinite, basically, like the whole premium. But that's very unlikely. The S&P 500 is most likely not going to fall to zero ever. It's never really fell to zero, so it'd be quite the catastrophe world event that would happen if that was the case. So most likely, you might be negative for a little bit, because the S&P 500 on average returns 9% a year. So, but yeah, the best thing about it is if you wanted to own SPY and you ended up buying it, when it fell, when the price fell, plus you got premium. It's like a win-win. And then you can do, which I'll make a video on it later, is selling calls, which is where once you have the 100 shares, because your cash will be held as collateral, because you'll need to be able to prove that you can buy 100 shares. Selling a call option, which again I'll make a video on that later, will be so your shares will be as collateral and you'll still get the cash up front, which is just amazing because then you can just rinse and repeat that strategy and make hundreds of dollars, at least